All right, crypto enthusiasts, buckle up. The market is a tornado of activity, and if you blink, you might just miss the next massive move. We've got breaking developments that are shaking up how we think about digital assets, from critical price points being tested to entirely new ways businesses are leveraging crypto. Stay locked in because you absolutely do not want to miss these updates. First up, are we seeing a stabilization point for Bitcoin? We're diving deep into key metrics that could signal a shift in market sentiment, and trust me, the numbers are telling a fascinating story. Plus, get ready for some insights into how innovative companies are tapping into the crypto payroll revolution, potentially changing the game for how businesses operate. But that's not all. We're also breaking down Bitcoin's critical support levels. Is $107,000 the new line in the sand? We'll explore what this means for market conviction and potential price movements, looking at both on-chain data and what the whales are doing. Will it hold, or are we in for a wild ride? And finally, we're questioning Bitcoin's very identity. Is it still just digital gold, or has it evolved into something far more powerful? We'll unpack how Bitcoin is now earning yield and what that means for its place in global finance and institutional portfolios. You're tuned into Bitcoin Bulletin, where we break down the biggest stories, so make sure you're subscribed and the notification bell is on. Bitcoin's MVRV neutrality signals stability amid emerging payroll opportunities. Is Bitcoin finding its footing? Experts are closely watching the market value to realized value ratio, or MVRV, as it hovers near a crucial neutrality point around 107.8K. This isn't just a number. It's a key indicator that could signal short-term price stabilization, balancing investor sentiment and potentially dialing down those speculative risks that have kept us on the edge of our seats. With the MVRV percentile currently at 39%, the market appears to be in a state of equilibrium, not overheated, but certainly not undervalued. This creates a fascinating backdrop for discussions around the future of crypto payroll systems. This neutral market sentiment is occurring alongside a notable rotation of capital between Bitcoin and Ethereum. While Bitcoin remains the king of market cap, Ethereum's recent performance has seen investment flowing its way. A common trend during consolidation phases as capital seeks opportunities in other innovative blockchain projects. This capital shift could moderate Bitcoin's immediate price action, suggesting a period of consolidation rather than an explosive breakout. For the business world, especially startups and small to medium-sized enterprises, SMEs, this environment is ripe with potential for crypto-based payroll solutions. Companies are increasingly adopting stablecoins like USDC and USDT to pay their employees. Why? It cuts down on costs, offers employees the benefits of digital assets without the wild price swings, and streamlines operations, especially for those with global teams. Imagine paying your international workforce seamlessly, cutting out traditional banking fees and delays. That's the promise. However, the path to crypto payroll isn't without its hurdles. Businesses need to navigate the complex landscape of regulatory compliance, ensure their employees are educated on using these new systems, and integrate the necessary infrastructure. Many are turning to employer of record, EOR, services that specifically support crypto payments, helping to manage compliance and simplify cross-border transactions. These solutions are crucial for companies looking to stay competitive and efficient in an increasingly digital financial world. The overall picture is one of cautious optimism. Bitcoin's neutral MVRV suggests a stable foundation, while the market rotation and the rise of crypto payroll point to a maturing digital asset ecosystem. This balance could encourage strategic accumulation by long-term holders, setting the stage for potential future growth, especially if broader economic conditions continue to align favorably. But what happens when this stability is truly tested? We're about to dive into the critical support levels that could define Bitcoin's next move. And that leads us directly into our next big story, Bitcoin's battle at the $107,000 mark. Bitcoin faces crucial test at $107K support amid volatility concerns. Bitcoin has recently pulled back from its highs, dipping below the $112,000 mark, a level that has proven to be a significant resistance point over the past few weeks. Now, all eyes are on the $107,000 level, which analysts are identifying as a key short-term support zone. This price point is critical, acting as a barometer for market sentiment and a pivotal reference for technical traders looking to gauge the near-term direction of the world's leading cryptocurrency. The significance of the $107,000 level is multifaceted. Market analysts suggest that a sustained hold above this price could reignite bullish momentum, potentially paving the way for Bitcoin to retest the $112,000 resistance and push higher. Conversely, a decisive break below this support could trigger a cascade of selling pressure, leading to a deeper correction. On-chain data is providing some intriguing signals, indicating a rise in buying pressure as the price approaches $107,000. This suggests that a cohort of investors is ready to step in and defend this level, potentially through increased long positions and activity from significant holders, often referred to as whales. However, this optimistic on-chain data is tempered by a noticeable decline in trading volume following the recent pullback. This reduction in activity is being interpreted in different ways across the market. Some see it as a sign of consolidation, where the market is digesting recent price action and preparing for the next move. Others, however, view the lower volume as a lack of conviction from buyers, raising concerns that the support at $107,000 might not hold if faced with significant selling pressure. This divergence in interpretation highlights the current indecisiveness within the market. The broader cryptocurrency ecosystem is reflecting this mixed sentiment. While Bitcoin consolidates, altcoins are showing varied performance. Major players like Ethereum have maintained relative stability, holding firm above $3,400, and Solana has stayed around the $130 mark. However, many other tokens are experiencing heightened volatility, underscoring the fragility of the overall market and the difficulty in achieving broad-based participation in the current cycle. From a technical analysis perspective, indicators such as the Relative Strength Index, RSI, and the Moving Average Convergence Divergence, MACD, have moved into neutral to slightly bearish territory. This cooling of momentum follows a period of aggressive price gains and serves as a reminder of the inherent volatility that characterizes the cryptocurrency asset class. While not necessarily signaling a bear market, these indicators suggest a period of caution is warranted. Adding to the complexity are macroeconomic factors and leverage. Despite a stabilization in open interest for Bitcoin futures, leverage ratios remain elevated. This means that a sharp price reversal, in either direction, could lead to significant liquidations, potentially amplifying price swings and adding another layer of risk for traders. Investors and analysts are closely monitoring upcoming macroeconomic data releases, particularly inflation figures and central bank policy announcements, as these external factors can significantly influence the broader risk environment and, by extension, the cryptocurrency market. While price action and market sentiment dominate the headlines, the fundamental role of Bitcoin itself is undergoing a profound reevaluation. Get ready to explore how Bitcoin is shedding its digital gold image and becoming something far more dynamic. Bitcoin's identity crisis, from digital gold to productive capital. For years, Bitcoin has been largely perceived as a passive asset, a digital vault akin to gold, with its fixed issuance schedule providing a predictable scarcity. However, this long-held narrative is rapidly evolving. With over $7 billion worth of Bitcoin now actively earning native, on-chain yield through various major protocols, Bitcoin is breaking free from its passive classification. This shift signifies a fundamental transformation, moving Bitcoin from merely being a store of value to becoming a source of productive capital, a change that is quietly redefining risk assessment, institutional reserve allocation, and portfolio theory. The core economic DNA of Bitcoin remains unchanged. The hard cap of 21 million coins, transparent issuance, and resistance to censorship or inflation by any central authority. These features of scarcity and auditability have always been its distinguishing factors. However, in 2025, these inherent qualities are beginning to unlock new dimensions of utility. As new protocol layers emerge, they allow Bitcoin holders to generate on-chain returns without relinquishing custody or relying on centralized platforms that might alter the base protocol. This means Bitcoin's fundamental mechanics are untouched, yet the way capital interacts with the asset is profoundly changing. This evolution is already evident in several key areas. Bitcoin is unique among crypto assets in its official recognition in sovereign reserves, with El Salvador continuing to integrate BTC into its national treasury. Furthermore, a 2025 U.S. executive order acknowledged Bitcoin as a strategic reserve asset for critical infrastructure. The burgeoning Bitcoin spot, exchange-traded funds, ETFs, now hold a staggering amount of Bitcoin, over 1.26 million BTC, representing more than 6% of the total circulating supply. This institutional adoption is a testament to Bitcoin's growing acceptance as a legitimate asset class. Even within the mining sector, a noticeable shift is occurring. Public miners are no longer solely focused on selling their mined Bitcoin to cover operational costs. Instead, a growing number are strategically allocating a portion of their Bitcoin holdings into staking and synthetic yield strategies to enhance their long-term returns. This move indicates a growing confidence in Bitcoin's ability to generate yield, integrating it more deeply into their financial planning. This transformation means that Bitcoin's original value proposition, its trustworthiness rooted in scarcity and decentralization, has subtly evolved. What made Bitcoin reliable now also makes it powerful, turning a once passive asset into a yield-producing one. This lays the groundwork for a native yield curve that could form around Bitcoin itself, as well as Bitcoin-linked assets, creating new financial instruments and opportunities. The ability to earn yield on Bitcoin without compromising control is a game-changer. New protocol layers now empower long-term holders to stake their native BTC, contributing to network security while earning returns, all without the need for asset wrapping or cross-chain transfers. Other platforms facilitate the use of Bitcoin within decentralized finance, DeFi applications, allowing users to earn fees from swaps and lending while retaining ownership. Crucially, these systems do not require surrendering private keys to third parties and avoid the opaque practices that have led to past failures in the crypto space. This is no longer a niche experiment, it's a burgeoning ecosystem. Miner-aligned strategies, in particular, are gaining traction among firms aiming to boost treasury efficiency without leaving the Bitcoin ecosystem. This development is fostering the creation of a yield curve that is native to Bitcoin, transparent, and self-custodied. However, as Bitcoin yield becomes more accessible and self-custodied, a new challenge emerges: measurement. Without standardized benchmarks to describe what productive Bitcoin yields, investors, treasuries, and miners are left making decisions in the dark. A clear, repeatable, self-custodied, on-chain yield benchmark, grouped by term lengths, is needed to transform yield generation from guesswork into a reliable financial metric. This shift from a passive vault to a productive asset fundamentally alters how we perceive Bitcoin's role in finance. But what happens when the market itself starts to dictate Bitcoin's immediate price movements? We're now turning our attention to the critical support levels that could shape Bitcoin's short-term trajectory. Bitcoin's $107K support level becomes key battleground amid mixed market signals. Bitcoin has recently experienced a pullback, trading below the $112,000 mark, a level that has repeatedly acted as a significant resistance. In the current market environment, the $107,000 price level has emerged as a critical short-term support zone, serving as a pivotal reference point for traders and analysts assessing market conviction. The ability of Bitcoin to hold this level will be crucial in determining its immediate price trajectory and the overall sentiment in the crypto market. Analysts are closely monitoring the price action around $107,000. A successful defense of this support could potentially trigger renewed bullish momentum, encouraging buyers to push the price back towards the $112,000 resistance and beyond. Conversely, a breakdown below $107,000, especially if accompanied by increasing volume, could signal a deeper correction, potentially testing lower price levels. On-chain data has provided some encouraging signs, showing a rise in buying pressure as Bitcoin approaches this key support. This suggests that a significant number of investors, including large holders or whales, are positioned to buy at these levels, potentially creating a floor for the price. However, the market is not without its uncertainties. A notable decline in trading volume has been observed following Bitcoin's retreat from higher levels. This reduced activity could be interpreted in two ways, either as a sign of market consolidation, where participants are waiting for clearer signals, or as a lack of strong conviction among buyers, which could make the support level more vulnerable. The mixed signals from volume data add a layer of complexity to the analysis, making it challenging to predict the immediate outcome. The broader cryptocurrency market is mirroring these dynamics. Altcoins are exhibiting mixed performance, with some, like Ethereum and Solana, showing relative stability, while others are experiencing greater volatility. This divergence highlights the current market conditions, where broader participation and confidence are still developing. Technically, indicators such as the Relative Strength Index, RSI, and the Moving Average Convergence Divergence, MACD, have entered neutral to slightly bearish territory. This suggests a cooling of momentum after a period of strong upward movement. While these indicators do not necessarily predict a downturn, they do advise caution and suggest that the market may be entering a phase of consolidation or potential retracement. The persistent volatility inherent in the cryptocurrency asset class remains a key factor for all market participants to consider. Furthermore, macroeconomic factors continue to play a significant role. Elevated leverage ratios in Bitcoin futures markets, despite stabilized open interest, pose a risk. A sharp price move could trigger substantial liquidations, amplifying volatility. Therefore, upcoming macroeconomic data releases, particularly those related to inflation and central bank policies, will be closely watched for their potential impact on the broader risk appetite and, consequently, on Bitcoin's price. Bitcoin's ability to hold these critical support levels is paramount for its short-term outlook. But beyond the immediate price action, the very nature of Bitcoin is being redefined. We're shifting gears now to explore how Bitcoin is evolving from a passive asset into a powerhouse of productive capital. All right, that's a wrap on a whirlwind of crypto updates. We saw Bitcoin's MVRV hinting at stability amidst new payroll opportunities, its crucial $107K support level being tested, and the fundamental question of whether Bitcoin is still just digital gold or has become productive capital. Don't miss a single beat in this fast-paced market. Make sure you're subscribed, hit that like button, turn on notifications, and follow us on all social platforms so you never miss an update. Your engagement fuels everything we do here at Bitcoin Bulletin.